Take a look at this chart. For decades, Forex traders have relied on a seemingly unbreakable rule for the Canadian dollar. Surviving in a market that constantly hunts for liquidity means looking past surface-level observations. You have to know exactly when the traditional links are about to snap. Profitable USD-CAD trading requires isolating the specific moments when the historical link between oil and the exchange rate fails. You cannot spot a broken roll until you mathematically define the standard behavior. Gut feelings about oil prices have to be replaced with hard, quantifiable data. The easiest way to start is the chart overlay method. Pull up your trading platform and drop the West Texas Intermediate, or WTI, crude chart directly on top of USDCAD. You are looking for periods where the two lines move like perfect mirror images. This rolling correlation coefficient plots the relationship between two assets from positive to -1. -1 means strong inverse correlation. Over a 60-day window, you'll see periods where the line pulls towards zero, meaning the relationship has temporarily vanished. Quantifying that baseline relationship gives you the mathematical proof you need. You can only trade an anomaly once you know exactly what normal looks like. That brings us to the divergence. A divergence happens when an external macroeconomic force temporarily overpowers crude oil's influence on the currency. Check the action on these charts. On the left, WTI crude surges and breaks a major resistance line. But on the right, the USD-CAD pair refuses to drop. It flatlines and drifts higher. This is a bearish divergence for the CAD. Even though oil prints massive green candles, something else is actively dragging the Canadian economy down, completely neutralizing the petroleum boost. And that creates your opportunity. When that temporary drag finally clears out, the currency pair frequently moves with significant momentum to realign with the high oil prices. The exact inverse is a bullish divergence. If oil prices are plummeting, but USD-CAD is falling right alongside them, that signals extreme structural weakness in the US dollar. These setups offer potential because once the temporary macroeconomic force fades, the exchange rate often moves to realign with the multi-decade energy trend. To anticipate those realignments, you have to track the fundamental drivers that cause them. Crude oil is loud, but other economic forces can scream right over it. The heaviest weight on the scale is the interest rate differential. This is the numerical gap between the policy rates set by two opposing central banks, like the Federal Reserve. If the Federal Reserve is aggressively hiking rates while the Bank of Canada holds steady, global capital will ruthlessly flow toward the higher-yielding US dollar. That tidal wave of capital pushes USD-CAD higher, entirely ignoring a concurrent rally in energy markets. Surprise economic data triggers the same reaction. A massive US jobs report or a sudden panic in global risk sentiment will send investors sprinting to the USD safe haven, snapping the oil correlation in minutes. Look at this dashboard for the ideal confluence setup. You want bearish signals on the oil chart, a favorable interest rate differential, and clean price action confirmation on the USD-CAD chart. When all three align, you have an elite entry point. Treating oil as the only variable in a petrocurrency is a rookie mistake. Institutional traders build their edge by synthesizing crude data with global monetary policy. Zooming out to the macro level, the landscape of 2026 brings structural challenges. The aggressive global push toward decarbonization and electric vehicles is actively altering the baseline demand for crude oil. Concurrently, the Canadian government is pushing hard to diversify its GDP. They are aggressively expanding technology hubs and domestic manufacturing, purposefully moving the national economy away from heavy natural resource extraction. As those service and tech sectors claim a larger percentage of Canada's economic output, the CAD behaves less like a pure petrocurrency. The inverse correlation to oil is becoming increasingly muted. That requires stricter defense. When you enter these trades, you must use an average true range, or ATR, stop-loss strategy. ATR is an indicator that measures the daily volatility of an asset. Setting your stop at 1.5 times the ATR gives your trade enough breathing room to absorb the growing lag between the oil and Forex markets. And the ironclad rule of position sizing applies. Never risk more than 1 to 2% of your total account equity on a single correlation setup. The USD-CAD oil relationship hasn't disappeared, but it has evolved. To capitalize on it today, you have to update your statistical tools. manage your risk aggressively, and trade the complete macroeconomic picture. Put these strategies to the test in a live market environment. Open a demo account with FXNX today, take advantage of 0.0 pip spreads, and start hunting for profitable realignments.